You know, usually when we sit down to do one of these, we're guilty of having a bit of tunnel vision. We'll say, okay, today is all about apartment complexes.
Right, or we're only looking at industrial warehouses.
Yeah.
Very neat.
Very tidy, exactly. But today,
Yeah.
I'm looking at a list that is just, well, chaotic is the only word for it. And I mean that in the best possible way.
Eclectic might be the polite real estate term for it, but yeah, chaotic works too. It really does run the gamut.
I mean, literally. On one line of this document, we have a tiny single-room office in Plano, Texas. It's basically a glorified closet. And then on the very same page, there's a massive shopping center in Oklahoma.
Anchored by a TJ Maxx and a Home Goods, no less.
It feels like we're looking at the entire economy in one single PDF.
And that's exactly why this specific source is so valuable for a deep dive. We're not just looking at random buildings for sale. We're analyzing the listings of the week from Eureka Business Group. This is from February 7, 2026. It's Joseph Goslin's firm, and for those who don't know, they are laser-focused on Texas and Oklahoma, specifically retail and commercial investment.
And Joseph has a reputation for this, right? I mean, he doesn't just throw a bunch of addresses on a page.
Right. What makes this list worthy of a deep dive isn't really the addresses themselves. It's the subtext. Joseph has this knack for curating these lists, not just by location, but by what I call the investment thesis.
That's the term. That's what I want to hang this whole conversation on today, investment thesis. Because to the untrained eye, and sometimes that's me, this just looks like a shopping list with price tags. But you're saying there's a narrative here.
Absolutely. Every single property on this list is there because it solves a specific problem or it captures a specific trend. So we're going to decode why a broker might highlight 0 landlord duties on one deal.
Which sounds amazing.
And then brags about short-term leases on another one.
Which sounds like a total nightmare.
Exactly. One sounds lazy, the other sounds stressful. But they're just different strategies for different types of investors. We're going to unpack the jargon, cap rates, NNN, value add, sealed bids, and really see what these listings are telling us about where the smart money is moving in early 2026.
Okay, let's do it. Let's unpack this. We'll start at the shallow end of the pool, the entry level.
Right.
We're looking at the under $2 million category. This is where I assume most individual investors would start their journey.
It is. This is the accessible tier. You don't need a hedge fund behind you to play here. But just because the price point's lower doesn't mean the strategy is any simpler.
So the first one that jumped out at me is in McKinney, Texas, a medical office space. But honestly, it wasn't the square footage I cared about. It was 2 words in the listing: creative financing.
That is luck.
It says owner financing available. Now, translate that for us. Why is that such a big deal in this market?
Okay, so think about how a traditional deal works. You go to a bank. The bank scrutinizes your tax returns. They look at the building's income. They charge you fees. And they set the rate based on whatever the Fed is doing that morning. It's a lot of friction.
It's a hurdle, a big one.
A huge one. And owner financing means the seller just acts as the bank. You pay them the down payment, and then you pay them the monthly mortgage payments directly. It bypasses that whole institutional lending environment.
So if credit markets are tight or interest rates are spiking, this is basically a golden ticket.
It's a get-out-of-jail-free card for financing.
Yeah.
But look at the value prop here, too. The notes say it's selling well below county-assessed value.
That felt weird to me. Usually the tax man assesses lower than market value, so you pay less tax. If it's selling below the tax value, is something wrong with it? Is the building falling down?
Not necessarily. It often signals a very motivated seller. But just think about the instant equity. If the county says it's worth $2 million, you buy it for 1.8, your balance sheet looks incredible on day one. Plus, this specific one is 2 combined units.
Which means options.
It means house hacking, but for your business. You buy the building, you run your own practice out of Unit A, and you lease Unit B to, say, a dentist. Their rent covers your mortgage. You're essentially operating rent-free.
That is the dream. Okay, let's move over to Grapevine, Texas. We've got 2 multifamily deals here, a 13-unit complex and an 8-unit that's 2 quadplexes.
These caught my eye immediately.
Really? Why? They just look like standard older apartments. Nothing flashy?
It's the note. The note says, limited multifamily supply in submarket. That is polite broker speak for you can't build here.
because Grapevine is historic.
Exactly. Grapevine is built out. It has a historic main street. It has tough zoning. The city isn't going to let you bulldoze a block of cute houses for a new high-rise, so the supply of apartments is effectively capped.
And we know from Econ 101, if supply is capped and demand is steady.
Prices and rents go up. It's a moat. If you buy these units, you don't have to worry about some developer building a brand new, better complex across the street next year. They physically can't.
And the listing says they're 100% occupied.
Which just validates the demand. You have cash flow from the minute you sign the papers. In a constrained market like Grapevine, buying existing inventory is often the smartest play. You are buying scarcity.
So that's the scarcity play. Now, what about the micro play? There's a listing in Plano, and it is tiny, 756 square feet.
I think my garage is bigger than that office.
It's a shoebox with a door.
Yeah.
It's a medical office unit near Willow Bend. Why would anyone buy a commercial space that small? Can you even fit a business in there?
Here's where you have to look at the demographics to get the thesis. The listing screams it. Very affluent demographics, with an exclamation point.
I saw that. They really wanted us to know rich people live nearby.
Because that is the business model. Think about who rents a 700 square foot medical office. It's not a hospital. It's a concierge doctor, a high-end therapist, a boutique esthetician.
Someone who charges a premium.
Right. And that provider needs to be located exactly where their clients live. If your clients are in Willow Bend, a very wealthy enclave, you want to be 5 minutes from their driveway. You're paying for the zip code, not the floor space.
So you're buying access to the wallets in that neighborhood.
Precisely. The high household income supports the business model of your tenant, which makes sure they can pay the rent.
That makes total sense. Okay, let's graduate. We're moving up to the $2 to $5 million bracket, and the whole vibe changes here. We go from hustling to fill units to what I'd call the hammock zone.
A mailbox money section, yes.
We have 2 childcare facilities, one in Prosper, Oklahoma, and one in Allen, Texas. And the listing for the Prosper one has a phrase I think every landlord dreams of: zero landlord duties.
That is the magic of the absolute NN lease, or triple net.
Okay, break that down, because usually if I own a rental and the roof leaks, I'm paying for it.
In residential, yes. But in an absolute triple net lease, the tenant is responsible for everything. The 3 nets are property taxes, insurance, and maintenance.
Everything, even like the structure of the building.
In an absolute deal, yes. If the roof caves in, the tenant fixes it. If property taxes double, the tenant pays the difference. As the landlord, your only job is to walk to the mailbox and get the check.
That sounds suspicious. Why would any tenant agree to that?
Because usually, the tenant is a national corporation. Look at the Allen listing. It says, national tenant with 600-plus locations. These companies, they prefer to control the building to maintain their brand standards, but they don't want to own the real estate on their balance sheet.
So they sign these long-term triple net leases, and that's why investors love them.
It's the closest thing in real estate to buying a bond. You aren't really betting on the building. You're betting on the creditworthiness of the tenant. That's why the listing highlights the corporate guarantee.
Meaning, if the local manager runs the business into the ground,
The parent company still has to pay that rent.
that is security.
It is. But you pay for it. Usually, these deals have a lower return, a lower cap rate, because they're so safe. You're trading upside for the ability to sleep at night.
Speaking of upside, let's look at this retail center in Louisville, Texas. Not a triple net deal, but it has a different kind of superpower.
The grandscape factor.
The listing says it's adjacent to the $1.5 billion Grandscape development.
This is a classic real estate strategy called drafting. You know, like in a car race.
Yeah.
Grandscape is this massive entertainment destination. They spend $1.5 billion creating gravity, pulling millions of people to that one specific spot.
And this little retail center is just sitting right next door.
Exactly. You don't have to spend a dime on marketing to convince people to drive to that intersection. Grandscape already did that. You just had to be there to catch the overflow.
It's like setting up a hot dog stand outside a baseball stadium.
Perfect analogy. Plus, the listing notes, the average household income is over $131,000. So you have traffic and disposable income. It's a very safe bet because the heavy lifting was done by someone else with much deeper pockets.
I love that. Let the billionaires pave the road. I'll just buy the toll booth. Okay, let's move on. Next category, 2 to 10 million. And this is where we see the term value add.
This is where the work begins.
Usually when I hear value add, I think fixer-upper. You know, broken windows, empty parking lots.
Right. Distress.
But look at this industrial flex property in Weatherford, Texas. It's huge, 36,000 square feet, and it's 95% leased.
Yeah, it's practically full.
So if it's full, where's the value add? You can't add tenants, is it? Painting the walls?
This is the most counterintuitive part of the list, and it's my favorite for that reason. Read the next line. Value add with short-term leases.
Wait, short-term leases, isn't that bad? We just praised the childcare place for an 11-year lease. Why would we want a short lease?
Context is everything. In a flat market, you want long leases for safety. But if you believe the market is rising, if you think rents are about to skyrocket, you actually hate long-term leases.
Because you're locked in at a lower rate.
Exactly. If you sign a tenant today at $10 a foot for 10 years, and next year the market rate goes to 15, you are losing money every single month. You're stuck.
Ah, I see. So short-term leases is basically code for opportunity to raise prices.
Bingo. It's a mark-to-market strategy. Weatherford is growing. It's on Interstate 20. The thesis is buy it, wait for the leases to expire in 12 months, and then renew everyone at the much higher 2027 rate.
That's an active bet on inflation.
It is. It's the polar opposite of this set-it-and-forget-it childcare deal. This is for an investor who believes growth is coming.
Speaking of aggressive math, let's look at this retail center in Enid, Oklahoma. The price per square foot caught my eye. $77.86.
That is remarkably low.
I mean, you can't build a shed for $77 a square foot these days.
No, you can't. Replacement costs would be double or triple that. So you're buying the bricks for pennies on the dollar. But the real story is the cap rate spread.
Break that down. It says 8.19% in-place cap rate with 9.75% pro forma.
Okay, so in place is reality. If you buy it today, based on the current rent checks, you make an 8.19% return.
Which is already very strong.
Very strong. Pro forma is the hypothetical future. It means if you manage it better, fill vacancies, and raise rents to market, you could be making 9.75%.
That's almost a 20% jump in your return.
Correct. So this is a lift play. You're buying it for what it could be. It requires execution. You have to be a good operator to close that gap.
It's not passive. You have to earn that spread.
Definitely not. And then there's a piece of land in Cedar Hill, 37 acres. But it's not for sale in the normal way. It says sealed bid opportunity.
It sounds like a movie plot. Why do a sealed bid? Why not just put a price tag on it?
It usually happens when an asset is unique or hard to value. What's 37 acres of residential land worth? Well, it depends on what a developer thinks they can build. 50 homes. 100. If the seller just puts a sticker price on it, they might guess wrong.
So they make the buyers guess instead.
They make the buyer show their hand. It forces what's called price discovery. You say, everyone give me your best and final offer by Friday at 5 p.m. It creates urgency and stops people from lowballing.
It's poker.
High-stakes poker, for sure.
All right, we've arrived at the heavyweights, the over $10 million category. This is where the institutions play.
The whales.
We've got a massive retail center in Edmond, Oklahoma, 160,000 square feet, anchored by TJ Maxx and Home Goods. I mean, this is a fortress.
It is. But I want you to look past the brand names for a second. Look at the traffic metric.
Oklahoma's busiest intersection, 66,000 plus VPD.
Vehicles per day.
66,000 cars every single day.
That is a staggering number. For context, a busy suburban street might get 15,000. This is a river of metal.
Why does that specific number matter so much?
Because for retailers like TJ Maxx, visibility is oxygen. They have these complex algorithms that tell them exactly how much revenue they'll generate based on how many eyeballs pass their sign.
So 66,000 cars basically guarantees a certain level of sales.
It creates a floor.
Yeah.
It makes the property internet resistant. You can't replicate the physical advertising of 66,000 people staring at your storefront every morning on their commute. That's why the listing highlights it.
And even at this scale, it says below market rents.
Which is surprising for an institutional asset. Usually these are priced to perfection. Finding below market rents in a center with that much traffic implies there's still some meat on the bone.
And finally, one more in Garland, Texas. 67,000 square feet, 100% leased, national tenants, but it's still labeled value add.
This is an interesting contrast to that tiny Plano office we started with. Remember the rich neighbors strategy?
Yeah, selling to the wealthy in Willow Bend.
This is the opposite. This listing highlights a strong traffic corridor and 39,000 vehicles per day. Doesn't mention household income at all.
So it's a volume play, not a wealth play.
Exactly. Tenants like Planet Fitness or Dollar General, they thrive on density. They don't need their customers to be millionaires. They just need a lot of customers.
So the investment thesis just completely changes. In Plano, you bet on wealth. In Garland, you bet on sheer activity.
Precisely. You have to know which game you are playing.
So looking back at this list, it's really a spectrum of philosophy. We went from a tiny office in Plano that relies on its zip code to a massive intersection in Oklahoma relying on 66,000 cars.
We saw zero duties, where you just cash checks, and short-term lease hustles in Weatherford, where you're actively fighting for rent increases.
It really highlights that there's no single right way to invest. The question isn't, is this a good building? The question is, does this match my thesis?
Are you playing the scarcity game, like in Grapevine? The stability game, like the N&N childcare deal? Or the operations game, like that Enid Retail Center?
I think my favorite takeaway is still that Weatherford short-term lease strategy. It's just so counterintuitive.
It is. And I want to leave you with a thought on that. If a broker is marketing short-term leases as a selling point in an industrial building in 2026,
Yeah.
what does that tell you about where they think the market is going?
It says they think rents are going way up.
You don't sell short leases if you think the economy is about to crash. You sell them if you think we're on the verge of a spike. It's a very, very bullish signal hidden in a boring real estate listing.
That is a provocative thought. If the smart money is betting on rent hikes, maybe we should all be paying attention.
Indeed.
Well, that wraps up this deep dive into the Deal Hunters ledger. A huge thanks to the source material from Joseph Goslan and Eureka Business Group for giving us such a playground.
Always a pleasure to decode the market.
For you listening, next time you drive past a for sale sign, ask yourself, is it a scarcity play, a traffic play, or a demographics play? The answer might just change how you see your own town.
Thanks for listening.
See you on the next deep dive.